Right, hi guys, welcome back. So Adam Khoo here, and in this video I'll be talking about the China stock market crash that's been happening because of this ongoing US-China trade war, and how I see this as a way to massively profit from this trade war panic. So a few of the facts. You've been reading the news, you know that the China market has been the worst performing stock market in the last 6 months, and it's right now in the bear market territory. So from a high of 3,600 points, it's a Shanghai Composite index that tracks the China mainland shares. It has been down 26% in the last 3 to 4 months, down to 2,744 points, 26% decline, and that's bear market territory. It's in a confirmed downtrend right now. So what has caused all this? And again, reading the news headlines, it's the US trade war, right? So the US started by imposing 25% tax or tariffs on $200 billion of Chinese imports coming to the US, and China has retaliated with its own tariffs. So there's this huge trade war going on, and China has been devaluing the Chinese yuan to make Chinese exports cheaper. And again, this has caused a further decline in the Chinese stock market, as a lot of people have been pulling money out of the China market because of the devaluing currency and putting it into the US market. So the US market has been moving up very strongly, and the China market has been moving down because of the trade war. So the US is winning this trade war in terms of market perception. But in the long run, I see China as a great potential to be invested in because there's huge profit opportunities. It's really cheap right now. China's really cheap right now, and the US is getting a bit expensive, right? At the same time, there have been concerns about slowing Chinese growth because of slowing, weakening domestic economy, which I think again is temporary, because in the long run, the Chinese population is growing massively, and China will be eventually the world's biggest economy, like it or not. Okay. At the same time, there have been deleveraging of high debt levels within Chinese companies. Chinese companies have been borrowing a lot to fuel their growth, and right now they're deleveraging, which is reducing their debt, which is what the US went through after the US financial crisis. So the lessons that we learned from the US financial crisis, after the crash, how it recovered, can now be applied to the Chinese market. So I made a huge amount of profits investing in the US markets. I still do, but now I see the Chinese market as a huge profit opportunity coming up right now. Okay, so before we dive into the opportunity, I like to share with you one of the few Chinese words I know, actually, right? Mandarin words I know, which is crisis, which is known as 危机. Okay, I hope I got it right? 危机, right? So in Mandarin, 危机 means crisis, and if you break up the word, 危 in Chinese means danger, okay, and 机 means opportunity. So that tells you that in every crisis, yes, there's danger, watch out, but there's huge opportunities as well. Now, I don't know about you, but for the last 26 years of investing and trading in the markets, I made my greatest profits because of decisions I made during crisis, political, economic, and financial crisis, that set me up to make huge profits when the crisis was over. So it was not the decisions I made after the crisis, but it was the actions I took during crisis that made me a millionaire many times over. So I like to share this knowledge with you so you can also build your wealth in the coming market cycles. All right. So before we understand why there's an opportunity, let's do a quick review of some facts about the stock market. If you have watched some of my earlier videos, I've talked about the facts about why the stock market can make an ordinary person really wealthy. So let's go through it right now. So fact number one, understand that the stock market always goes up in the long run. It's guaranteed to always go up. Now, let me make a disclaimer here. I'm not saying that any stock you buy will always go up, okay? Some stocks you buy can drop and never come back, right? Because when you buy a stock, you're buying part of a business, and you never know which businesses will succeed, guaranteed, and which businesses will fail. For example, if you bought Research in Motion that made BlackBerry about 15 years ago, you bought Nokia 15 years ago, you'd have lost 90% of your investment, as these companies, they lost their market share. And will they ever go back? No one knows. I don't think so, right? Companies like WorldCom or Enron used to be great companies, and they collapsed. They never returned. They went bankrupt. So I'm not saying that a specific company you buy will always go up. What I'm saying is that the stock market as a whole will always go up in the long run, guaranteed. Because the stock market is measured by indexes or indices. So in the US, it's the S&P 500 index. In China, it's the Shanghai Composite index. So why is it that the stock index will always go up in the long run? Why? Right, there are three reasons. Number one is inflation. Inflation always means higher prices in the future, higher property prices, higher stock prices. Number two is population growth. So as population grows in China, in the US, all around the world, there's more consumption. So companies have to keep growing to supply a bigger population, so companies keep increasing in value over time. The next thing to understand is that the stock index is made up of the 30, for example, 30 biggest companies in the market that represents the whole market. And these 30 companies or the index companies, they change all the time. So the moment a company is no longer doing well, it's kicked out the index, replaced by a better company. So for example, companies like AIG, Citigroup, General Motors, General Electric, they were in the index, the Dow Jones index in fact, but they were removed and replaced by better companies like Apple, Visa, Nike, and Goldman Sachs. So it's always the best companies in the index, and that's why the index will always go up in the long run, and the market will always go up in the long run. So if you take a look at the S&P 500, this over the last 90 years, okay, so there's a long track record, right? In fact, the US market has been around for over 140 years, okay? So 90 years is just a subset of the 140 years. So you can see that the S&P 500 has increased by 16,000%. That's not a typo, right? 16,000% over the last 90 years, from 1928 to 2018 today. 17 points, okay, to 2,860 points today. So the point about the stock market is you always win if you hold long enough, right? So in the long run, it always goes up. But in the short term, the stock market is like a roller coaster, right? Every time it goes up, it comes down. Every time it goes up, it comes down. It goes up, it comes down. It goes up, it comes down, right? It's like a roller coaster, right? It goes up and down, and all those things. But every time it goes down, guess what? That's right, it goes a lot higher, much, much higher over time. So that's fact number one you got to understand, okay? Fact number two, the stock market makes annual gains 75% of the time. So on any given year, if you buy the stock market, the stock index in January, and you sell it in December, right, 75% of the time, 3 out of 4 times, you end up with a gain, right? So you can take a look at, this is the last, here's this, okay. Let me just take a quick calculator and check. Yeah, this is the last 67 years, right? So in the last 67 years, you can take a look at the year-to-year gains and losses. And again, you can see that 75% of the time, the market ended up with a gain, right? Fact number three, stock prices don't go up in a straight line. They don't go up every day, every month, every year. Stock prices move in cycles, okay? Or we call them trends. So what you see over here is stock markets go through what we call bull market cycles and bear market cycles. So a bull market is known as an uptrend. And on an uptrend, prices make higher highs and higher low points. So you can take a look that, for example, in this period, this was known as the bull market cycle. Bull market, bull market, bull market. So why is it a bull market? Because it makes higher highs or higher peaks, right? And higher lows. That's right, right? So higher highs and higher lows. So in a bull market or an uptrend, prices still go down. But every time they go down, they go higher. They go down, they go higher. Higher highs, higher lows. So bull markets happen during economic growth and optimism, when everything is rosy, hunky-dory, right? So bull markets don't last forever, right? It's kind of like summer doesn't last forever, right? After summer, you got to have winter. But after winter, summer comes again, right? So in the stock market, winter is known as the bear market. So in a bear market, all right, that's the bear market, known as a downtrend. So in a bear market, prices go up and down as well. But every time the price goes up, it goes lower. It goes up, it goes lower. So in a bear market, prices tend to make lower highs, lower high points, and lower low points. All right, so you got to understand that, right? So you got bull markets and bear. So right now, China is in a bear market, okay? And you're going to see why it's an opportunity being in a bear market. Okay, so that's fact number 3. Okay, so again, if you take a look at the chart itself, this is the S&P 500, the US market for the last 30 years or so. Okay, so can you recognize during this period where was the bull market, where was the bear market? Let's take a quick look. All right, so as you can see, this was the bull market. That's right, bull market over there. Price makes higher highs, higher lows, uptrend, economic growth, optimism, hunky-dory, right? Now this was a bear market, right? This was the dot-com crash, right? So it's an economic crisis. And this was the bull market again. Bull market, all right. And then we had boom, bear market. And this was the US subprime financial crisis, bear market again, right? And boom, bull market, all right. So currently the US is in a bull market. It's been a bull market for the last 10 years, in fact, all right? So there you go. Bear markets, bull markets. And you can see after every bear, there's a bull. After every bull, there's a bear. So, fact 4, bull markets are opportunities. Now, one of the things you got to understand again, stock markets are in bull mode 90% of the time. 90% of the time, the stock market is on an uptrend. And bull markets are made of what is known as impulse and correction patterns. What does that mean? So an impulse means going up, correction is going down. It's like go up, go down, go up, go down. Impulse, correction, impulse, correction. Take 4 steps forward, take 1 step back. 4 steps forward, 1 step back. It's kind of like a dance. Impulse, correction, right? And these step backs are known as corrections or known as temporary dips in the market that usually they dip about 5 to 15%, right? So the prices drop 5 to 15% before going higher, 5 to 15% going higher, okay? And these dips typically last an average of 1 to 2 months. And right, you don't have to be a genius to know that these corrections or dips are buying opportunities, right? So you can see, goes up, dips, buy, goes higher, dips, buy, higher dips, buy, higher dips, buy, higher dips, buy. So notice, as you're buying on the dip, you're buying at the best price and making a profit. Buying on the dip, making a profit, right? So that's fact number 4. Bull markets are opportunities when you buy the dip of the bull market, buy the dip of the uptrend. And one of the best ways to recognize the end of the dip is using moving averages. And I've talked a lot about this in previous videos, okay? And I know I'm repeating what I've been saying in previous videos because I need to lay the groundwork. I need to understand the basics before I dive in back to the Shanghai Composite Index. I dive into the China market so you understand why China is right now a great money-making profit opportunity. So you gotta understand these basics, right? So bear with me if you really know this stuff, okay? So again, we use moving averages to identify the end of the dip. So you can see on an uptrend, these moving averages, which is the 50, 150, and 200 moving average. This is the blue line, the green line, and the red line. So whenever the market's on a clear uptrend, the 50 is above the 150, the 150 is above the 200. It's always in sequence, blue, green, and red, like a rainbow, right? And every time the price dips, it will bounce off one of the moving averages. As you can see, it goes, dips, it bounces off the 50 moving average. Goes up, bounces off again, goes up, bounces off again, bounce, bounce, bounce. So you always wait for it to bounce off a moving average to buy the dip on the uptrend. Pretty straightforward stuff. Okay, now fact number 5. Bear markets are bigger opportunities to make even more money. I love bear markets. I love them, okay? People are scared of them, but I love them, right? I love winter. I love to ski in the winter. I can't do it in Singapore, so I have to travel to Europe to ski, to have fun in winter, right? So bear markets come, Let's go back to that. Understand? Bear markets come every 8 to 10 years. Okay? And bear markets tend to last anywhere from, well, actually 6 months to 2 years on average, right? And during a bear market, stock prices tend to drop an average of 30 to 40% on average. But in a severe bear market, all right, stock prices can drop 50 to 60%, which means if you know when to buy, you're getting a 60% discount buying great companies, buying the stock market at 60% discount. Okay? The good news is bear markets never last, like discounts never last. Okay? It's always followed by a bull market. So again, after a bull market, bam, you got a bear market. And this was a 40% decline. All right, and then it went bull market again, bam, 60% decline, or that's about 55% decline, and boom, bull market again. So you must know when to buy during the right time in a bear market. Okay. Now the good news is that bull markets and bear markets are very easily identified by looking at what we call the price action patterns. Again, higher highs, higher lows, reversing to lower highs, lower lows. And to aid our identification, we use again moving averages. Again, the 50 moving average and the 150 moving average, and the 200 as well. Okay. So again, I've taught this many times in my previous videos. I'm going to repeat it again for those of you who are watching this for the first time. That on an uptrend, the 50 moving average is above the 150. The blue line is above the green line, and they are sloping up. Whenever you see the 50 moving average, the blue line crossing below the 150 green line, and the moving averages start sloping down. You can see the cross over there is sloping down. Boom, that's the start of a bear market. So that's when prices will tend to get lower and lower for anywhere from 6 months to 2 years. And it can drop again anywhere from 20% to 60% during this bear market. All right, so low gets lower, cheap gets cheaper. And you want to avoid buying during the bear market. You want to wait for the bear market to bottom and reverse into a new bull market before buying your sports shoes and catching the next summer. Okay, so again, over here you can see a bear market, right? So there's a bear market over here. And again, the bear market is the opposite, right? So the 50 moving average is below the 150 moving average. Okay, and sloping down. And you want to wait for the 50 to now cross back above the 150. The blue line to cross back above the green line, and both lines must be sloping up. So you can see, for example, over here, the 50 crosses above the 150, but it's still sloping down. So that's not a reversal of the trend. Now over here, this is a trend reversal, right? 50 crossing 150, and both lines are sloping up. That's the start of a bull market, and that's when to get in to catch the rest of the uptrend bull. All right. So I've just covered again the basics of understanding stock markets. So once you understand this, let's now dive in to look at the Shanghai Composite Index, the China stock market story. Okay, so I began by showing you a chart that showed you that in the last 4 months, the Shanghai Composite Index, that again measures the Chinese stock market, is down 26% for the last 4 months. It's in a bear market, in a downtrend. Okay, so it looks scary to a lot of people. Oh my God, it's going down. Oh my God, it's a trade war, it's a crisis, right? But let's kind of like look at a bigger picture, right? So let's look at the last 24 years of the Chinese stock market. Now, the Chinese stock market officially has been modernized in the last 29 years. Since 1990. But I've only got data for the last 24 years. That's good enough, right? So you can take a look that from 1995 to 2018, the Chinese stock market has gone from 800 points to 2,700 points today. It made a high of 6,000 points and another high of 4,000 points. So currently it's at 2,700 points. So from 1995 to 2018, the total return, if you invested then and you held it now, the total return, it's about 279% return for the last 24 years. And if you annualize it on an annual return, it's about 7.16% compounded annual growth. Okay, and on average, the dividend yield paid by the companies is about 2%. So your annualized return, total capital gain plus dividend yield is about 9% a year for the last 24 years. Okay, so understand it. And again, like the US market, the Chinese market always goes up. It always goes up, right? It goes up and down, but it always goes up in the long run. Now, let's take a closer look at the last 24 years. Can you recognize the bull and bear market cycles? Right? Take a close look. So over here, you can see this was a bull market, right? This was a bear market. This was a very, very crazy bull market. Went 90 degrees up, and what goes 90 degrees up tends to come 90 degrees down, right? So this was a bear market, right? There's a little bull, and there's a bear market over here. There's a bull market over there. Okay, bear market over here, bull market over here, and we just started this bear market over here. Now you can see that the Chinese stock market is actually a lot more volatile than the US markets, right? US markets, bull runs tend to last longer, and bear markets tend to last, well, I wouldn't say longer, but yeah, the US market tends to be a lot less volatile. You know why? Because in the US market, about 85% of the stocks are held by institutional investors that tend to hold the stocks longer. But in the Chinese stock market, about 80% of the stocks are held by retail investors. People on the street who don't have financial knowledge. So the moment they see the market going down, they panic and they start selling. They see it going up, they buy. So it's a lot more volatile in the Chinese market. So it's more like a roller coaster ride. But if you know how to read the trends, you can make a lot of money in the Chinese stock market, taking advantage of this volatility. So let's take a closer look at the Chinese market now. So again, this is the last 24 years and all the crises that have unfolded. So you can see that when the market kind of like began in 1990, right, there was a 61% drop over here. Boom, 61% drop. Right, my God. Okay, and after the 61% drop, the market went up 362%. Okay, and then we had the Asian financial crisis that started in Southeast Asia. Okay, and then the market dropped 32%. There was another little bear market over there, and after it dropped 32%, boom, it went up 112%. Right, and then we had the US .com crash in the year 2000, and we had the SARS epidemic, which was this viral infection where people died because of this immunity, epidemic, right? So then the market went down 40%, another 26%. So this was like two bear markets together. And what happened after that? Then the market went up 500% after that, right? And then the global financial crisis started in the US, and boom, down 73%. And then boom, up 206%. Okay, and then we had China's Black Monday that happened in 2015. That was caused by fears of a slowing economy, right? And down 50%, and recent trade war down 26%. So again, like the US market, you can see, right, every time it goes down, in this case 61%, it goes up even high, 300%. Goes down 32%, goes up 100%. Goes down 60%, goes up 500%. Goes down 70%, goes up 206%. It always goes higher, right? So although it takes 2 steps back, it takes 5 steps forward. So how do you know when is the right time to invest into a stock index? I look at 3 things. The first thing I look at is valuation. Is the stock market expensive or is it cheap? So number 1, valuation. Number 2, I look at the trend of the market. Is it on an uptrend or is it on a downtrend? And the third thing I look at is I look at support and resistance levels. So I'm going to start by talking about valuation, whether a stock market is expensive or cheap. So how do we tell if a market is over or undervalued? So one of the ways is using the index PE ratio. So PE ratio, for those of you who have not learned this, stands for price to earnings ratio, right? Price divide by earnings. So one of the things to understand is that stock markets move in cycles, right? They go through up cycles and then they reach a top when it's too expensive and it crashes down and it gets really cheap, people start to buy, it goes up again, it crashes down, and this cycle continues. Okay? So how would you know whether you're at the top of the cycle or at the bottom of the cycle? Okay, so again, we use the index price to earnings ratio. So how is this PE ratio calculated? Basically, you take the price of all the companies in the index. So you take the total price of all the companies in the index divided by the earnings of the companies to get the index PE ratio. So basically what happens is when the market is at a high, prices are very high. Okay, prices are very high relative to earnings. So in other words, PE ratio is very high when the market is at the top of the cycle. Now after a stock market crash and the market's at the bottom, what happened? Prices now become very low, very cheap, right? So prices become very low relative to the company's earnings. So PE becomes very low, right? So in other words, when PE is very high, we are at the top of the market. When PE is very low, we're at the bottom of the market. So the question is, what is high, what is low, right? Well, it depends on historical benchmarks. So let's take a look at these benchmarks right now. So this is the PE ratio of the Shanghai Composite Index for the last 16 years, from 2002 to 2018. So you can see that in these 16 years, the stock market went to a high where the PE ratio was 70 times earnings. In other words, stock prices were selling at 70 times the company's earnings. For every $1 the company earned, people were paying $70 to buy the shares, which is ridiculous. It's so expensive, and that's why it crashed, right? It's overvalued, okay? And historically at the low, after a crash, the lowest PE ratio was 10, okay? And this happened back in 2014, where it reached about the 10 PE ratio. So the median is about 40, okay? So what does it tell you? This tells you that when the China stock market's at the PE ratio is 10, it's really cheap, it's at the bottom. And when it's at 70, it's at the huge top, it's going to crash. And when it's at 40, about 40, it's about the center, okay? So the question is, where are we now? So if you go to Bloomberg and you check the PE ratio of the Shanghai index, currently, I just checked it yesterday, in fact, the PE ratio is 13.32. 13.32, which means it's right here. All right. So in other words, the China stock market currently is really, really cheap. It's at a PE of 13, when the lowest in history has been 10. So we are near the bottom. Okay. I'm not saying it can go lower. It could still go lower, but it's near the historical bottom. And the China market is not expensive at all. It is undervalued, and it's a fact. Now, let's compare that to the US market, which is the S&P 500 index. And let's look at the PE ratio for the last 86 years, from 1929 to 2014. And for the US market, the highest PE reached was about 30, okay, in that period. Well, actually not 30. It actually reached about 30. Okay, fine, okay. And the lowest PE was about 5. So at 5, the US market's at the bottom, and at 30, it's kind of like at the top. Can you see that? And the average is 15. The PE is 15. Okay? So where's the US market now? The US market's PE ratio as of yesterday is 20.81. 20 times earnings, which means we are now here. Currently, we are here. So what does it tell you about the US market? It tells you that the US market is not cheap, okay, because below 15 is cheap, but it's also not really that expensive because the top is 30. So I would say it's now between fair value and expensive. It's slightly above fair value. It's a bit expensive, but it still can go much higher. But the Chinese stock market's at 13, it's really cheap. And that's why I'm really bullish on China right now. Now, do understand that I primarily invest only in the US market. Okay, so I'm not saying put all the money to China. I'm saying for me, I'm putting part of my money into China, but the majority of my money is still in the US markets because that has, again, huge growth right now. I'm riding the uptrend, but I'm looking at China in the next few years to really provide me some huge profits. So I'm allocating about 20% of my portfolio to the Chinese market. And I'll teach you how to do that in a short while. Now, another reason to invest in the Chinese stock market is not just because it's cheap, but it's because it's got tremendous growth opportunities even higher than that of the US market. Now, the US stock market and US economy has dominated for the last 70 years since World War II. But like it or not, China will eventually become the world's biggest economy, the world's biggest stock market. And there's no stopping. It's just getting started, in the words of Negan in The Walking Dead. All right? And let's look at some of the facts. The US stock market is worth $19 trillion right now. The value of all the companies in the stock market is $19 trillion. And the US stock market has been around for 223 years. Now, the Chinese stock market has been around for just 28 years. And it's really at $5.9 trillion. Right? It's a lot more catching up to do, a lot more growth opportunity. Now, the US economy is growing at 2 to 3% because it's a mature economy, right? The Chinese economy is growing at 6 to 7%. The US population is 323 million. The Chinese population is 1.4 billion people. 50% of Americans own stocks through their 401k and so forth, right? But only 7% of urban Chinese own stocks. So what does it tell you? It tells you that there's still 93% of Chinese that have not bought stocks yet. So once they start buying stocks, guess what? More money flows into the stock market, and the stock market can go up a lot higher. And again, with a bigger population and 6 to 7% growth. Okay? And again, you can look at the S&P 500 for the last 90 years. I don't have 223 years of history, I just have 90 years. And in the last 90 years, the stock market has grown 16,000%. 16,000%, I've mentioned that before, right? And currently the PE ratio is about 20 times PE. The Chinese stock market has grown 200% in the last 26 years with a PE of 13%. So in other words, if you take a look at China, the stock market is just at the beginning. It's kind of like going back to the US market and saying, hey, in terms of the US history, China is just somewhere here. It's just at the beginning of a huge growth in the future, and you can't ignore it. I can't ignore it. And the other reason to understand is this. The Chinese are outspending the Americans in technology, artificial intelligence, machine learning, and deep learning. All right. In fact, the Chinese have had over 600 patents approved in artificial intelligence compared to just 103 American companies. So China is outspending Americans in terms of innovation and AI, and that would lead the future to, and we know that innovation leads growth. So something to look at. All right, so if you're not living in China, you're not a Chinese citizen, how do you invest in Chinese stocks? How do you gain exposure to the Chinese stock market? For me, one of the easiest ways is by investing in ETFs or exchange-traded funds that track the Chinese market. And there are many ETFs. If you go to Google and you type China ETFs, you have a whole list of them. And one of my favorite ETFs to track the China market is the SPDR S&P China ETF. All right, and the name of the ETF is the GXC. And one reason why I like this ETF is because it's got one of the lowest management fees or expense ratios. You can take a look over here. This is from Morningstar, which basically is a company that kind of like rates and analyzes stocks and ETFs. You can see for the GXC, Where is that? That's right. The expense ratio is 0.59%. So it's not even 1% management fee. So it's 0.59%. It's a pretty low cost ETF. All right. And you can see that the GXC, it invests in companies that are in the Shanghai Composite Index. So the top holdings of the GXC would be things like Tencent, all right, which is the biggest social media company in China, the largest online gaming company in China rolled into one. Okay, you've got Alibaba, which you've heard of, China Construction Bank, Baidu, which is their version of Google, and the Industrial and Commercial Bank of China. So it's basically the biggest companies in China is in the GXC. So let's take a quick look at the GXC on charts and let's analyze it. Because I said earlier, there are three things I look at. Number one is valuation, right? So it's cheap, but number two, let's look at a trend, right? Is it on an uptrend or downtrend? Number three, where are the support and resistance levels? So let's jump into the charts right now. All right, so in front of me is the GXC chart, right? So this is again the China ETF, and this for the last 12 years. So you can see where we are right now. Okay, first thing I'm going to put in the support and resistance levels. Boom, so there we go. So these are all the support and resistance levels, and this is the current support over here that was just broken. I'm going to zoom in a while, but let me just show you. So there's a support level over there. This was a resistance level that will become potential support. There's the next support level, support level, support level. So again, these support levels act as kind of like floors where the price will go and hit a floor. If it breaks the floor, it'll go to the next floor. So it's kind of like levels of defense, if you will, right? And you can see this was a long-term trend line going up there. So if you zoom in right now, let's kind of like zoom in to where we are. So the recent high over here was at about $125 per share. Around $25 per share. Now, this ETF is priced in US dollars because it is listed in the US market. Right, it's $125 per share. And there was a support over here, a support of $102. So again, it's been down by over 20%, right, from the high. So it recently broke that support, right? It broke that support, but it may jump back up again. So I'm going to watch. Sometimes it can be what we call a false breakout. False breakout reverses back up again over here. So watching that level now. If it continues to fall, the next level of support would be $92, about $91, the next level of support. And if it breaks that one, then the next potential level of support would be $70. All right, so I'm watching all these levels of where to get in potentially. So these are the support levels to tell you where price could find a potential floor. F-L-O-O-R, floor. Okay, now, the next thing is I'm going to put in my moving averages, which is basically my 50, 150, and 200 moving average to get a sense of the trend. Right, so you can see over here, this was a clear uptrend, clear bull market, all right, because the price, or rather the 50 moving average is above the 150 moving average. All right, so there's a clear uptrend. Now over here you can see that the 50 moving average has crossed below the 150. The blue is below the green line and they're sloping down. So this is definitely a confirmed downtrend. Okay, so if you're following the trend, now's not the time to buy yet, right? Because now's the start of a downtrend. So again, it's cheap. I mentioned that the China market is cheap, but you know what? On a downtrend, cheap could get cheaper, low could get lower. So I'm watching to see how low it could go. I'm watching the next level, again, it's $91. Next level is $70. And I'm looking to enter, okay, potentially when I see it hit a support level and the trend is beginning to reverse upwards. So that's what I look at. So currently, like I said, not a good time to enter yet. Broke the support, downtrend pattern. We gotta wait and see. So remember, investing is all about timing. We know it's a good company. We know it's a great ETF. It's a great market, but we have to watch our timing. So subscribe to my videos, and I'll give you more updates about where the market is right now and when's the best time to get in. But before that, a quick word about entry and exit rules in investments. Spotting a great investment opportunity is not good enough. To really profit in investments, you must have a solid investment plan of when to enter and when to exit. And there are basically two approaches in investing. And again, this is different from trading. In trading, there's a stop loss. In investing, you're holding for the long run, there's no stop loss. And again, I like to give this metaphor. Investment is kind of like marriage. It's a long-term commitment. There's no stop loss, there's no protection. Okay? But when you are trading, it's kind of like a one-night stand. You need protection for a one-night stand. So I'm talking about investment here in China market, not a short-term trade, it's a long-term investment. Okay? So there are two approaches. One is known as a buy and hold approach using dollar cost averaging. And dollar cost averaging is a simple method. Basically, you invest a fixed dollar amount at regular intervals. For example, you decide to invest $2,000 or $5,000, whatever it is, make it a fixed amount at regular intervals. For example, you invest $2,000 every 6 months or $5,000 every 12 months, whatever the case. And by doing dollar cost averaging, it guarantees you never buy at the top, you never buy at the bottom, you buy at the average. So let's take a look at how dollar cost averaging works. Okay, so remember that you should only use this on the index where you know it will always go up in the long run, and not use this on an individual company that could go bust. Okay, so let's imagine you're investing $1,000 every 6 months, for example, and this is what an index looks like. In the long run, it goes up, but in the short term, it goes through big ups and downs. So if you start investing at this level at $5, $1,000 would buy you 200 shares. Okay, so say you invest now, you buy 200 shares. 6 months later, it goes to $20 a share. Are you happy? No, you shouldn't be happy. You should have no emotions when it comes to investing. Do the same thing, no more, no less, invest $1,000. So now at $20, $1,000 buys you 50 shares. So now you buy less shares. Okay? Say 6 months later, it crashes again to $10. So now $1,000 buys you 100 shares. 6 months later, it goes to $50. Again, don't be happy. Do the same thing. Invest $1,000, no more, no less. Now at $50, $1,000 buys you 20 shares. And you repeat the process, so on and so forth. So notice what happens. By investing a fixed dollar amount, what happens is when the price is really high, you buy less shares. You buy only 10 shares. When the price is really low, you buy more shares. So by buying more at a cheaper price and buying less at a higher price, what happens? It averages your cost to just the center of the market cycle, right? So in this case, you're paying an average of $40.55. So this guarantees you're buying at the fair price, and that's dollar cost averaging. So that's one method you can use in investing. The second method is trend following. So trend following simply means you follow the trend. So again, you only buy during a bull market or an uptrend. And again, you can identify using the moving averages I talked about. And once it's an uptrend, you keep buying during the dip, right? So it dips, buy, dips, buy, dips, buy. So you keep buying on these mini dips to ride the cycle up. And the moment you see a downtrend, right, where you see the moving average sloping down, get out, sell everything, and let it collapse 50 to 60% and bottom out and buy it back when it gets back up again. So this has been how I've been making millions of dollars in the last 26 years, how I've built my wealth. I'm financially free. I hope this sharing can really help you to get there as well. All right? So this is Adam Khoo, and I look forward to seeing you in future videos. Take care. If you like this video, click on the subscribe button to get my latest video updates every month or every week. If you want to check out my live trading courses in Asia or check out my online investing and trading classes, do check out wealthacademyglobal.com for my live classes in Asia or piranhaprofits.com for my online professional stock and forex trading classes. This is Adam Khoo, and I'll see you guys soon. May the markets be with you.